Okay, so we are continuing our lecture. Now we will see buyback of shares. Okay, so what is buyback? Typically, purchase of own shares by the company. Buyback is alternative way of reduction of share capital. Okay, so this is the concept. So what happens is, suppose company is having 50,000 shares, number of shares, equity shares. Okay, equity shares. of rupees 10 each. Okay, so company will decide to buy its own share. So company will buy some of, like, as per the limits specified by the law, as per the conditions, company will buy back some of the shares from this 50,000. So let us say company is buying back 10% shares. Okay, so 5,000 shares, this will get reduced and my capital will remain as 45,000 into rupees 10. This will be my balance capital structure, like balance equity share capital. Okay, so why company opts for this option is, like, there are certain advantages. Okay, so over the year company has earned sufficient profits, their reserves are accumulated, like general reserve, securities premium reserve, like mainly general reserve. Okay, so in your balance sheet there is a section called reserves and surplus. So over the period my surplus has got accumulated into those reserves, and now like I can buy back my own shares. Okay, and reduce the number of equity share capital. So one advantage is that because of this my EPS gets better. Okay, ratio, which is earning per share. Okay, and how this is calculated is earning available for equity shareholders, okay, divided by number of equity shares. Okay, so for example, my company is earning let us say every year 2 crore rupees of net profit, and after net profit, after paying all my taxes, after paying to the debenture interest, after paying to the preference share holders dividend, whatever is left is, let us say, 2 crores. Okay, so 200 lakhs rupees in lakhs. Okay, and I am having let us say 1 crore of shares, okay, in numbers, so 100 lakhs. So my EPS is 2 rupees. Now I have sufficient reserves to buy back certain amount of shares. Okay, so if I buy back, let us say 25% of the shares, so what will happen, my denominator will automatically decrease. So this will be 75 because 25 lakh shares I have bought back. Okay, I have made the payment to the relevant shareholders at the market price, and now my share, that number of shares are 75 lakhs. So ultimately when I calculate my EPS, that will come around 2.66. okay, so this improves the earning per share ratio. Okay, so this is one of the advantages. There are other advantages also which we will see in theory, but in today's, like in this part, we will see the numerics related to buyback and the conditions which are there for buyback of shares. Okay, so can I buy like I have sufficient reserves, so can I buy the equity shares back as per the reserves? So the answer is no. There are certain conditions given in the law. So these are the main 3 conditions based on which we decide how much a company can buy back in a particular financial year. Okay. So the conditions are only fully paid up equity shares can be bought back. So let us say there are 10,000 shares. Okay, out of which 8,000 shares are fully paid up, that is rupees 10 is fully paid by the shareholders, and 2,000 shares only rupees 8 is called up. Okay, 2 is still, like, your final call is still not called up. Okay, in that case I can buy back out of only this 8,000 shares. Okay, so only fully paid up equity share capital can be bought back. Okay, and if I have to like go for this, then firstly I have to make this partly paid shares into fully paid share. I have to make that call. I have to make these shares, all the shares fully paid up, then I have to proceed for the buyback. Hope you have understood this part. Okay. Next is maximum limit. Okay, how to calculate the maximum limit of the buyback. So buyback cannot exceed 25% of paid up equity capital in financial year. Total buyback, okay, equity plus other securities. So if I am buying back equity shares plus there is a redemption of preference share, let us say, so total buyback cannot exceed 25% of paid up capital, total paid up capital and free reserves. Okay, after buying back those shares, my debt to equity ratio, it should not fall below 2. Okay, that is 2:1. So for example, I am having a debt of, let us say, 50 lakhs. Okay, so after buyback, my equity, total equity, that is equity share capital plus free reserves, that should not be less than 25 lakhs. Okay, which is in that case my debt will be more than 2. Okay, if I calculate the ratio. Okay, so debt equity ratio is simply, the formula is like this. Okay, your total debt secured plus unsecured, okay, that is your loans, all the loans, divided by equity plus free reserves. Okay, so suppose my total debt is 50 and my equity is let us say 30. Okay, so in that case my debt to equity ratio will be 50 divided by 30, that is 1.66. okay, so this is a better equity ratio. Okay, because my equity is more compared to that debt is in below 2. Okay, so let us say if I buy back 5 shares out of this, so remaining is 25. Now how much my debt to equity ratio will be? It will be 50 divided by 25, it is 2. Okay, so it will be like 2:1. Okay, that is your 50 divided by 25. Hope you are following this. Okay, equivalent to 50 divided by 25. So up to this point it is allowed. Okay, suppose out of 30 I am buying back 10. Okay, out of 30 I am buying back 10 equity shares. Okay, so that will be 30 minus 10, this will become 20, and my ratio will become 50 divided by 20, 2.5. correct? So this is not allowed. Your ratio should be 2 or below 2, so that is permissible. So hope this is clear how to find out the debt equity ratio. Okay, and this is after the buyback, not before the buyback. Okay, so we will see one example quickly which is given in the module, and how to calculate the maximum limit for the buyback. Okay, so what is given, following information is available from the audited balance sheet. Equity share capital 30,000 rupees in lakhs. Okay, so 30,000, 3 lakh shares of rupees 10 each. Okay, so this is fully paid. You can see 3,000 into rupees 10, 30,000. So these are fully paid shares. Then we have securities premium, which is 3,000. So securities premium is free reserves, part of free reserves. Then we have general reserves 10,000. This is also we are assuming as a part of free reserves. Then we have secured loan 40,000 and unsecured loan of 22,000. Okay, and compute maximum limit to which buyback is permitted. Okay, in one financial year. So what we will calculate? So we will calculate 25% of the paid up equity capital. Okay, so what is my paid up equity capital is 30,000. Okay, this is all rupees in lakhs. Okay, 30,000 into 25%, which will be 7,500. Okay, the next condition is equity, like currently we are buying back equity only, there is no preference share or anything here, only equity shares are given here. So 25% of paid up capital and free reserves. Okay, so how much my paid up capital? 30,000 plus how much my free reserves? 3,000 and 10,000. So 30,000 plus 3,000 plus 10,000. Okay, that will come as a 43,000, right, into 25%. So 43,000 into 25%. 10,750. Okay, so we are seeing the maximum limit. Okay, now after buyback the debt equity ratio must not exceed 2:1. That means it should be 2 or below 2. Okay, so how we will calculate that? My debt equity ratio, debt divided by equity plus your free reserves. Okay, how much is my debt? 40,000 plus 22,000, right? And this is we are calculating after buyback. Okay, after buyback. Okay, so equity plus free reserves less buyback price. Okay, less buyback in this case. So how much is my equity? This is like 43,000 we have calculated here. Okay, so 43,000, and how much we are going to buy back, that we are calculating, so that will be x. Okay, this should be less than or equal to 2. Okay, so if we solve this, okay, 62 divided by 43 is equal to minus x is equal to 2. So if we solve this, we will get x is equal to 12,000. Okay, so how much maximum I can buy back is lower of all these three. Okay, so I have to meet the condition. If I go for 12,000, and then maximum permissible as per this particular condition is 25% of paid up, which is coming to 7,500. So how to read this? Lower of all these three. Okay, so So after calculating all these three, whichever is lower, that will be my amount available for buyback, okay, which is rupees 7,500. If you like check this particular example in module, so there is one calculation error. Instead of x, they have taken 2x here, okay, so their ultimate calculation has came as 6,000, okay. So whichever is lower is like they are getting the answer at 6,000, but that calculation is wrong, okay. This is the correct calculation, and 7,500 I can buy back of total amount. So market price can be anything, it can be 15 rupees, 20 rupees. So divide by the buyback price will get give you the number of shares that will be buyback, okay. So divide by buyback price per share. So this will give you number of shares to be buyback. Okay, so hope you have followed this. Next is the important concept to for your numerical sums is okay. So if you want, I'll just or you can pause and you can make your note of this particular calculations. We'll move on to the next concept, which is your capital redemption reserve, okay. So what they are saying is, where a company purchases its own shares out of free reserves or securities premium account, a sum equal to nominal value of shares so purchased shall be transferred to the capital redemption reserve, okay. So just see the capital structure, okay. So how my capital looks like in balance sheet, okay. So there will be equity, there will be reserves, say there is preference shares, and there are debentures, okay. So these are basically securities, okay. There can be a loan. So this is basically my capital structure. So let us say this is 500 rupees in lakhs. Reserves is, let us say, 300. Preference shares 200, and debentures 500, okay. Loan will not consider for the time being. Let us say loan is also there for 100, okay. So my total capital including equity plus debt is 1,600, okay. Now out of this, okay, by using the reserves, I have decided to buy back 100 worth of shares, 100 worth of shares, okay. So after buyback, my equity will become 400, correct. So my capital structure will come down to 1,500, okay, keeping all this constant. Just wait, okay. This is like going out of the screen, that was checking for that. I'll just rewrite all these things. Okay, so coming to our point of capital, redemption reserve. Okay, so suppose my capital structure is like this. Equity, how much we have seen? 500. Reserve, this is general reserve of 300. Then there is a preference share of, let us say, 200. Debenture, let us say 300. And there is a loan of 200. Okay, so this is coming to 1500. Okay, this is my total capital structure. Okay, debt plus equity. Now I am buying back 100 out of this, so 400 equity shares will remain. Now I am buying this out of general reserves. Okay, so to that extent I have to reduce the general reserve. So for this we will transfer the nominal amount. Let us say this is face value only, we have bought back at face value, so we have to transfer the nominal amount of to the extent of buyback to one account called capital redemption reserve. Okay, to represent that out of general reserve we have done this buyback. Okay, so my accounting entry will be general reserve will get debited 100 to capital redemption reserve CRR. Okay, 100. So this will get this will remain as 200, and one new CRR will be there for 100. Okay, and rest will also remain same in this case, 200, 300, 200, and ultimately it will be 1400. Okay, now there is one typical catch in CRR, like to the extent of buyback I have to create the CRR. Now let us say for this 100, buyback of this 100, just pay attention carefully. Okay, in question it is given that we have issued new debentures of 50, and balance we have utilized general reserve of 50. Okay, so in that case I will create CRR of only 50, and this will be 250, and there will be new debentures of 50. So this debentures plus 50, this will become 350. Okay, so hope you have understood this, so that we will see in some also, but this is the typical concept. Okay, we will see other conditions also. Authorization, so the buyback must be authorized by the company's article of association. If that clause is not there in article to buy back the shares, then first the company needs to amend its article of association and then proceed for the buyback. Next is your approval. So up to 10%, if the company is buying 10% of its total paid up equity, share capital and free reserves, in that case board resolution is sufficient as approval. If the buyback is more than 10%, okay, and 25% is your maximum limit, okay, so 10% to 25%, in that case we have to take special resolution from the shareholders. Okay, Then sources of buyback is your free reserves. Out of free reserves you can buy back. Securities premium account. Okay, securities premium account can be used for buyback. Then proceeds of issue of shares and other specific securities. So I can issue new securities also for funding my buyback. Okay, which we have seen. Like first example, we have seen 100 rupees we have used total general reserves, and in second example we have seen that 50 rupees I have issued new debentures and 50 rupees I have utilized from the general reserve for buying back of 100. Okay, then the company must not default. Okay, so company should not be defaulted in the repayment of its deposits, redemption of debenture and preference shares. This redemption is like when the debentures are matured, at that time company should make the payment of dividend is declared and it should be paid. Repayment of term loan. Okay, so when you are doing all these payments on time, only then you can go for a buyback. Okay, it cannot happen that company is making default in this fixed payments, and then they are buying back the equity shares from the free reserves. Okay, that cannot be the case. Okay, so we have to check this first, the company has not defaulted any repayment in case of deposit, debenture, preference share, declared dividend and loan interest. Okay, then buyback must be completed within 1 year from the date of resolution. When we have passed this resolution, from that date within 1 year your entire buyback must be completed. Okay, then no further issue of same kind of shares within 6 months except bonus and your employee stock option plan. Okay, so if I am buying back let us say shares of rupees 10 each, okay, in that case I cannot issue like fresh shares of rupees 10, but I can give bonus shares to the existing shareholders. Okay, so we are like the basic advantage which we want to gain is to improve the EPS. Okay, and if I'm buying back the shares and the similar kind of shares I am issuing again within 6 months, okay, then that purpose is defeated, right? My denominator again will come to the same number of shares. Okay, but I can give the bonus shares to the existing shareholders, so that increases their wealth. Okay, this we can see in detail when we will see the financial analysis chapters. Okay, then this is your compliance. The declaration of solvency has to be filed in form SH9, that company have the sufficient funds to buy back its shares, and there is one written in form SH11. Okay, so this is your compliance point. Now we will see one sum related to buyback. Okay, we will solve this sum. This is easy sum. This has been asked for 5 marks, December 2024, so very recent question. This we will see. Okay, so this is the balance sheet given, and the 4 points are given for your related to your buyback. Okay, so we will read the balance sheet first. Balance sheet as on 31st March 2024. Shareholders fund, share capital 50 lakhs, 5 lakh shares of 10 each, so this is fully paid shares. Okay, reserves and surplus 35 lakh 25,000, total equity is 85 lakh 25,000, long term borrowings 20 lakhs, current liabilities 3 lakhs. Okay, then fixed assets 66 lakh 50,000, non-current investment 7 lakh 50,000, current asset include trade receivable 5 lakh, inventories 5 lakh, cash and cash equivalent 24 lakh 25,000. Okay, totaling to this. Then one note is given, reserves and surplus includes securities premium of 10 lakh. Okay, so your this reserves and surplus. Okay, I'll just start making working notes. Okay, you also make this working notes in your answer sheets. because I guess writing on question papers is not allowed in the exam. So when you get your answer sheet, you start preparing the working notes. Okay, and it should be below your main answer. So leave the one page for your main answer, and then on the other page you can start making the working notes. And working notes should form part of your answer. Okay, so reserves and surplus, the amount is, this is rupees 35 lakh, 25,000. Out of this, securities premium is 10 lakhs. Okay, 35 lakh, 25,000 minus 10 lakh. So we are assuming this is general reserve. Whatever is left, 25 lakh, 25,000. Okay, this is my working note. Next is on 1st April 24, shareholder of the company authorized buyback. Okay, so shareholder, they authorized the buyback. How much? 10% of equity shares would be bought back at 17 per share. Okay, so do we need to check the maximum limit here? No, because it is 10% below 25%, and let us just check the debt equity ratio in this case. Okay, just that. So my total debt, it is straightforward given that we are buying back 10% at 17 rupees. No need to do this working note in this particular sum, but we are just checking the debt equity ratio. Okay, divided by equity, total equity plus free reserves minus my x, this should be 2. So my total debt is long term borrowing 20 lakhs plus my trade payables 3 lakhs. Okay, so 23 lakhs. And though trade payables are not part of your main long term borrowing, we are just considering it. Okay, or let us say 20 lakhs only. This is my debt, 20 lakhs divided by total 85 lakh, 25,000 minus x. So my x will be equal to 2. Okay, so 20 lakh divided by 2, 10 lakh, plus 85 lakh, 75,000. So this will come as my x will be 75 lakh 75,000. Okay, how much we are buying back? 10% at 17 rupees. So 5 lakh equity shares into 10%, that will be 50,000, and my buyback price is 17 rupees. Okay, so 50,000 into 17, that is coming at just 8 lakh 50,000. Okay, so well within this limit, right? So we have just checked after my buyback, this is well within the limit. Okay, so this is done. Then what we are doing? Okay, so this is also will split. Okay, 10 rupees for face value and 7 is towards premium. Okay, so 5 lakh and 3,50,000. Next is 12% debentures to be issued for 1 lakh to finance the buyback. Okay, so like we have seen that example, 50 by issuing new securities and 50 by utilizing the general reserve. This is same kind of a sum. So 1 lakh is financed like by new debentures and balance from general reserve. Okay, then premium on buyback to be met by securities premium. So securities premium, how much we are having? 10 lakh. Okay, so this will be made by securities premium, and 5 lakh will be made by 1 lakh from debentures and 4 lakh from general reserves. Okay, so one more working note. See, this will be made by securities premium, so this is done. Now how much for nominal value? Okay, how much we are buying back? Nominal value 5 lakh. Okay, out of that new debentures, how much we are giving? 1 lakh, and 4 lakh will be out of general reserve. So this will be transferred to capital redemption reserve, CRR. Okay, so this is my one working note. Then investment would be sold for 11,75,000. This is to maintain the liquidity and paying of this 8,50,000. Okay, so we will pass the journal entries now. Okay, so first we will pass the simple journal entries. Okay, so first is investment sold. How much it sold? 11 lakh 75,000. This amount I will receive in my bank account, right? What was the cost of the investment? If we can see this non-current investment. Okay, what is the cost? 7,50,000. Okay, just make a tick mark. Okay, habit of this. Wherever there is a adjustment, so investment there is one adjustment, then reserves and surplus there is adjustment, like there is a calculation. Okay, and of course equity share capital, and new issue is debentures. So at these three places my balances will change, right? So cost is 7,50,000. Okay, so this is selling price minus cost. This is my profit on sale of investment. How much? 11,75,000 minus 7,50,000, so 4,25,000. Okay, so what will be the entry? Bank account debit, because I am receiving the money. Debit what comes in? 11,75,000. Okay, what is going out? My investment is going out, so to investment. How much? 7 lakh 50,000. And we have gain, so as per my rule, credit all the incomes and gain, so to profit. Okay, 4,25,000 profit on sale of investment. This will ultimately get transferred to your P&L account, profit and loss account. So people directly write profit and loss account also here. Okay. Next is what you have issued debentures, right? How much? 1 lakh rupees. So again, issue of new debentures. Issue of 12%, no? 12% debentures. 12% is the interest rate, okay? 12% is interest rate of these debentures. Like you must have seen the FDs, right? So 7% FD, so you will get 7% interest on that fixed deposit. Like that, this 12% debentures, this 12% means on these debentures you will get 12% of interest per annum. Okay, so we are getting 1 lakh rupees. So debit what comes in, we are receiving money. So bank account debit 1 lakh to 12% debentures, 1 lakh. Okay, fine, so far so good. Now next is what? These two entries we have done. %, debenture and sale of investment. Okay, now we are buying back the shares. Okay, so my third entry will be buyback of equity shares. How much shares we are buying back? This is your, I'm just making small working note here. 50,000 number of shares. Okay, 10 is towards your nominal value, 7 is towards your premium. So that is your 5 lakh and 3,50,000, right? 3,50,000. So 5 lakh, what I will debit? Share capital. Okay, that is your face value, and this is your securities premium. So this is also I will debit, and this is already funded by your securities premium, which is already having balance of 10 lakh rupees. Okay, so the entry is fairly simple. This is your share capital account, debit to the extent of face value into 10 rupees, 5 lakh. Then your securities premium account will get debited. How much? 3,50,000. Okay, to whom we are going to pay this money to? Shareholders, right? So to shareholders account, total 8,50,000. Okay, and this is the payment. So shareholder account debit 8,50,000 to, now the money is going out, so to bank account 8,50,000, right? All over? No, What is remaining is our capital redemption reserve. What we have calculated? So nominal value 5 lakh, out of which 12% debenture. How much contribution? 1 lakh. So remaining is 4 lakh. 4 lakh is out of your general reserve. Okay. So we will transfer this amount from general reserve to capital redemption reserve account. Okay. So this is your final entry. General reserve account debit to capital redemption reserve account. Okay, how much? 4 lakhs. Okay, so this completes your buyback of shares. In next part we will see bonus shares and preference shares and redemption of preference shares. Okay, thank you. Just revise this part, solve the easy questions in your module. We'll see you in next part.